if they revalued to 6,600, that'll just offset the budget deficit, which would be the increase in national debt at the end of this year, not next year and the year after. And so you and I calculated this, and I think we came out with something like $142,000 or $147,000 an ounce to wipe out the national debt. And that would upset the entire global economy. Plus, if you try and pay down the debt and pay it off, you're destroying. So this currency would come into existence, and then you're destroying the dollars, the principal that goes to pay back the treasury bonds. And so, I don't know if this would be hugely deflationary, inflationary, but what it will create, I can guarantee, is a roller coaster that will hit everybody. It'll just blindside everybody. Nobody will be able to predict what's going on.
The widening gap between official gold pricing and the actual movement of global liquidity is becoming impossible to ignore. Revaluation scenarios now show how fragile the U.S. fiscal structure has become, with even a dramatic jump to $6,600 per ounce covering only a single year's deficit rather than reducing the accumulated debt. Attempts to artificially fix the balance sheet through price resets merely reveal a deeper problem. Every adjustment destroys currency on one side while inflating obligations on the other, creating volatility that cascades across the global system. Meanwhile, long-term price patterns show unmistakable structural suppression within Western trading hours, contrasted by consistent upward pressure when markets shift eastward, an imbalance sustained for decades and now reflected in persistent physical shortages and chronic underpricing of mined supply. Mike Maloney, a longtime educator on monetary history and sound money, emphasizes that these distortions are not accidental mechanics, but the inevitable outcome of a debt-based currency model that hides wealth transfer through balance sheet manipulation and inflation leakage. As structural deficits widen and global reserves continue diversifying, the metals market appears positioned for a repricing far beyond today's benchmarks. Now, we present the clips from Mike Maloney's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
This is the monetary system. This is the way our monetary system works, is this balance sheet stuff that sort of hides what is actually happening. The actual purchasing power, if they increase the currency supply, is going to come at the expense of inflation. So the purchasing power is stolen from the public and given to the government to spend by doing it. There's a lag time, but also we did the calculations before, and it required this doesn't even cover the deficit, because we're going to have a deficit of a couple $2 trillion. That revaluation that they were talking about from 42.22 up to, which you may as well, it's close enough to zero to just say $0 to $3,300. And that is like finding $1 trillion suddenly. So you find this magic $1 trillion that comes from nowhere. You type these new numbers into existence on your balance sheet by calling gold a higher price. But there's a $2 trillion deficit that year. So it doesn't even cover the deficit. They were talking about reducing the debt. No, it's not going to reduce the debt. So you go from 3,300 to 6,600. Now you got $2 trillion, and that offsets. So if they revalued to 6,600, that'll just offset the budget deficit, which would be the increase in national debt at the end of this year, not next year and the year after. And so you and I calculated this, and I think we came out with something like $142,000 or $147,000 an ounce to wipe out the national debt. And that would upset the entire global economy. Plus, if you try and pay down the debt and pay it off, you're destroying. So this currency would come into existence, and then you're destroying the dollars, the principal that goes to pay back the treasury bonds. I don't know if this would be hugely deflationary, inflationary, but what it will create, I can guarantee, is a roller coaster that will hit everybody. It'll just blindside everybody. Nobody will be able to predict what's going on. And it's all a bad idea. And you know what? It's too late. We really should have been using gold and silver as money, as the Constitution mandates for this entire time. We've been the rug has been pulled out from under us. The wool has been pulled over our eyes. We have been tricked. All this sleight of hand, balance sheet, accounting gimmickry is how this is concealed, that it's just a wealth transfer that's going on. So anyway.
Exactly. And to your point, any realistic number that they might pick, like the market price to revalue it, it's not even the deficit for 1 year. It's
Right.
and then you're out of options. Then you like you can't
And
revalue it again.
People don't understand, a lot of people, the difference between deficit and debt. The debt is the accumulated deficits year after year after year. So if the deficit is going to be $2 trillion, just to not have a deficit and have no change in the national debt, we would have to revalue gold to roughly, if it was $3,300 to gain that $1 trillion, then we'd have to revalue it to $6,600 just to offset. And they're talking about trying to reduce the debt with this. And so they're trapped. There's going to be some horrific event eventually, and the free market will be trying to figure this out, and it will be better than all of the politicians and the people that think they're masters of the economic universe that run the Federal Reserve and so on, rushing in to save us. And every time they do something, it only makes the problems worse. If the only market that existed for gold was London trading, the price would currently be $3.76 an ounce.
Yeah, I think so. If people didn't get it, if gold only traded during London hours, and when the markets closed at night, if you pretended that overnight trading didn't happen at all, and when it opens up in the next morning, you just kind of paste the gold price back to back and keep going, you would see that it keeps going down and down and down and down and down, day after day after day, whenever the London market is open. And an ounce of gold would be $3 right now, not 4,000, $3.
Yeah, so the LBMA is nothing but a price suppression scheme, but it happens little tiny increments every single day, going down and down and down. Okay, let's move on.
Exactly. So the flip side of the coin is what's happening in the other markets. So when London is closed, so overnight, if you take all those gold prices and paste them back to back and look at the cumulative return, you'd see that the price of gold goes up and up and up and up, and it's just shy of $40,000 an ounce. So 10 times higher, roughly, than today's price.
So all of the percentage change of the hours where London is closed, London is not trading. And so you're taking the percentage change today, you're pasting it to yesterday of when London was not open. And this is amazing. And this is evidence that is like 100% irrefutable. This is it. LBMA is nothing but a gold price suppression scheme. The whole thing. Yeah, LBMA is a scheme spelled SCAM.
Yeah, scam. Exactly. Yeah. So big thanks to James Henry Anderson for providing these charts from Gold Charts R Us, Nick Laird.
Yeah, Nick Laird.
So amazing. So looking at those two together on the same chart, it kind of looks like this. So the first line is this black line, price going down a lot. The second line is this blue line going up super high. And then the actual price of gold that we're familiar with, that's this red line up, around 4,000 an ounce.
Wow.
So that's what it looks like. And it's a similar story with silver, by the way. Just looking at the same kind of lines, silver during London hours is down. It's a few cents, 23 cents. Silver would be 23 cents an ounce.
Wow.
So that's unbelievable. It'd be about almost $400 an ounce outside of London hours. And then, of course,
we're at that price where we say that it's going into triple digits. And I've been saying that for years. And this is proof that it should be there. And this is actually the reason for the structural deficit. When it doesn't pay to mine the stuff, you have not enough coming to market to fill demand. And that's what we've had for many years now in a row, a huge structural deficit.
Exactly. And one thing people might say to kind of argue against this point, just broadly speaking, in terms of gold and silver, is that, well, there's a flow of metals from west to east. And so if there's selling pressure in the west and buying pressure in the east, that could cause the difference in price here. And that's true in a small way. There's no way it could be this extreme for 50 years. There's no way. So
exactly. And the other thing is that the LBMA is that blue line incorporates COMEX trading hours. And the LBMA is only open, they're running like 5 hours earlier in the day. So there's only a couple hours overlap in that PM fix. So the COMEX is also, it's a fractional reserve scheme, whether it's a price suppression. Well, it is a price suppression scheme. People from JP Morgan went to jail over it. For years, the Gold Antitrust Action Committee has been screaming foul, screaming that there is a manipulation going on, and they've been laughed at and called conspiracy theorists. And then somebody goes to jail for it. And people still call them conspiracy theorists. And then another person goes to jail for it. And so what does it take to wake everybody up that this is price suppression? And it's happening in both gold and silver. And it's the LBMA that is one of the main culprits. And, if you look back over the last decade, you'll find that there are banks that pulled out of the price fix. The price fix is just a group of banks that decide gold and silver they look at market prices and they decide this is the fix. And then a lot of dealers are selling off of that fix all day long. Then at the close of the day, there's a PM fix. And this is the proof that they are the key culprits here.
The latest shifts in global gold flows reveal how fragile the Western paper pricing system has become. Unusual inflows into the United States, at a moment when domestic output usually leaves for Swiss refineries, signal an emergency effort to stabilize a market that was nearing structural failure. By redirecting metal from Switzerland, London, and even China, a sudden breakdown at COMEX was avoided, preventing an explosive price repricing that could have driven gold into the multi-thousand-dollar range overnight. These interventions highlight how deeply fractional the system is, with layers of leased gold, paper claims far exceeding deliverable supply, and artificial pricing centered around legacy institutions. As evidence mounts that Western trading suppresses prices. At the same time, overnight markets push it higher. The broader implications become clear. Physical scarcity, international repositioning, and currency realignments are converging into a pivotal transition point for metals and monetary policy. Let's get back to the interview.
The U.S. mines gold, and then we've got to ship it somewhere to get refined. And a lot of those refineries are the Swiss gold refineries. And so it is typically net exports. So this is highly unusual. Now, this was when Donald Trump was threatening to audit Fort Knox. This was during a rush, and I believe COMEX stocks were getting low again because the COMEX is another fractional reserve scheme. 300 people dancing around the room and only one chair to sit in. The actual ounce of gold that exists on the exchange for delivery. And so they've changed those ratios. And whenever they're doing this, they're getting ready for something that might happen. So they're getting ready for a potential event. I want to point out that this chart is from July. So it'll be interesting to see what happens over the coming few months here. So
yeah, exactly. We'll have to keep following this.
Yeah. So there was some gold inflows into the United States in July. So they basically saved the COMEX from a force majeure, and they stopped gold from like just leaping to $5,000, $6,000, $10,000 an ounce by having all these gold inflows from the Swiss refineries and from London and even from China, which had never happened. So it's like the whole world was coming to the rescue of the COMEX to keep the fraud of their fractional reserve scheme from being exposed, which would have caused gold to just suddenly leap into the stratosphere. And what was gold's price back in 2019 and early 2020? Was it still below 2,000?
Yeah, you can see. Oh. Yeah, right here. This is the 2,000 line. So it just peaked above 2,000 barely.
Well, that's with those big inflows. But before the inflows happened, we were down at 1,700, 1,500. Yeah, amazing. All of the gold that the U.S. does have has been pledged to the Federal Reserve and is used to back Federal Reserve notes at $42.222222 on into infinity, 42 2/9 dollars. Central banks lease gold, period. This is a fact. And if that gold is all leased and they want to do something with it, they would have to unwind a bunch of those leases. And if they unwind those leases, it causes the price to rise. So this is could be part of what is driving the price. But
exactly.
Yeah. So is the government accumulating gold? It wouldn't surprise me, because China has been doing it secretly. They report a certain amount, but it is suspected that the actual amount is more than double what they're reporting.
Exactly. And remember the golden rule: he who has the gold makes the rules. What happened in the Plaza Accord? Well, that was back in 1985, and finance ministers from France, Germany, Japan, the UK, and the US came to an agreement in the Plaza Hotel in New York City to intentionally devalue the US dollar. In the 5 years leading up to the Plaza Accord, the US dollar had doubled in value. So double in value in 5 years, threatening to upend global trade and destabilize the international financial system.
Right.
Today, we could do something similar. That's kind of the idea here. So just to show you what that looked like in a chart, the DXY is here in green. So we can see the dollar relative to a basket of foreign currencies basically doubled in value from roughly 80 to 160 in 5 years. So that's a lot of value gained in a short period of time. And that basically disincentivized manufacturing, and the US had to do something about it. So they basically encouraged all these other countries to allow the dollar to fall in value. And so, Mike, do you want to jump in here?
Well, I remember this pretty well, because sometime in 84 or early 85, my father had a heart attack, and he was hospitalized to have quadruple bypass surgery. And it was just before he was supposed to leave on a trip where everything was paid for. All the airline tickets, the hotels, everything was booked, ready to go. And he was supposed to tour several different countries. And our dollar was so strong that it was very profitable to be an importer. And so he sent me in his place. Now, I was young then and really didn't know what I was doing, but it was interesting. I was in the Netherlands first, and I bought a full-length pigskin suede trench coat, beautiful trench coat that, if you bought it in New York City, would have cost at least $1,000. I bought it for $27. I bought these beautiful ties for like $5 a piece, $3 a piece in the Netherlands. I couldn't believe how inexpensive things were. But there was a mirror image of that for anybody traveling to the United States from abroad. Everything was astronomically expensive, including our exports to other countries. And so this was needed, and sort of countries, it had gotten so that their goods were so cheap that compared to ours, that they wanted things to be devalued, but the dollar to be devalued. So this was a cooperative effort where they sold their currencies and they bought the dollar, and we sold the dollar and bought their currencies.
Growing pressure inside the global gold system is revealing just how distorted Western price signals have become. As gold inflows quietly rushed into the United States, arriving from Swiss refineries, London vaults, and even China, the structure of the paper market was showing signs of strain. These movements were not expected trade flows. They reflected an urgent need to prevent a liquidity event at COMEX, where the fractional reserve nature of the system leaves far more paper claims than metal. Price behavior during different trading windows reinforces this imbalance, with Western sessions consistently suppressing value, while overnight markets account for nearly all upward progress. Together, these patterns highlight mounting stress across the monetary landscape as central banks, governments, and large institutions position themselves ahead of significant structural change. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.